Meeting of the Santa Barbara City Council Finance Committee will now come to order. Are there any members of the public wishing to speak on topics within the jurisdiction of this committee but not on today's agenda? Seeing none, we will move on to the first agenda item.
Thank you, Mr. Chair, members of the committee. Excuse me. We have two items today. One is the March 31st investment report, and we also have a budget item. If it's okay with the committee, we'd like to start with the investment report, get that out of the way.
Of course.
It's a short report.
Sure.
And then we'll move on to budget. And with that, I'm going to turn it over to Jeannie Wilson, our Treasury Manager, to give the report.
Thank you. As Bob mentioned, I'm here to present to you the quarterly investment report. I've outlined some areas that I'd like to discuss.
Sorry.
Sorry. I've outlined some areas I'd like to discuss, including economic highlights, portfolio activity, and the portfolio interest. Treasury yields basically have remained exceptionally low. I know you've seen these reports for the past quarters, and not much has changed. In fact, the Fed forecasts anticipate low yields in the near future. So we're not looking at anything changing anytime real soon. So we're going to go over those rates in a little bit. For portfolio activity, though, we did have 14 million agency securities called or matured, 13 million purchases in agency securities, 6 million purchases in Treasury notes, and our LAIF balances are at 26 million. For the portfolio interest, again, not much different than the last quarter. We had 547,000 interest earned during the quarter, very similar to what happened with the last quarter. Portfolio yield slightly down this quarter to 1.387, which is 47 basis points down from the last quarter. What you'll see now is a summary of the investment portfolio. As I mentioned, again, the LAIF balance is at 26 million. Yield to maturity, if you can take a look at that, it's just 0.285%, very low. We do have certificates of deposit at 1.267, Treasury securities at 0.45, and federal agency issues at 89 million, corporate medium-term notes at 10 million, and you do have a Santa Barbara Airport Treasury note of 5.6 million. And a Santa Barbara Bank and Trust money market. That overall 1.387, again, slightly down from the last quarter. Here's what I'd like to show you is a breakdown of the investment interest earnings. Again, pretty much averaging 180 or so per month, for your total of just over $500,000 for the quarter. Not much there.
Okay.
Very low rates. This next bar graph gives an idea of where we've been in the area of yields from March of 2010 to March of 2013. You can see that slight gradual decline. And we don't expect those to change anytime soon. We are, keeping abreast of the market and talking to our brokers. But we would expect that we're going to be in the same environment for a little while. And that's pretty much it.
Questions from committee members?
No.
Okay.
There was just one. Bob and I spoke earlier about if you do receive essentially the same packet every quarter. If there's any additional information you would like to see, please let us know. Basically the same format of where our monies are, how much they're earning, and what the market is doing is essentially what we're going to cover.
Okay. Thank you very much.
Sure.
Okay, Mr. Samario.
Yeah, the only thing I would add to this is that number that you see, the bar chart that's through the blue, it'll likely continue to decline because we still have securities in our portfolio that are earning higher than that. So as those mature, we're going to be reinvesting in a lower interest rate environment. So from a budgetary perspective as well, and you'll see this in our multi-year forecast, we're anticipating revenues to continue to go down in the next few years until the rates start to go up. And it's like the Titanic. It's a slow-moving ship, and it'll take a while before we see our revenues start to increase again. So with that, I want to...
Let's not use the text.
I know.
Okay. The Queen Mary. Good point. It sometimes feels like the Titanic.
Captain Armstrong.
Yeah. So we're going to move on to the budget. This is the first of the meetings we're going to have with the committee to go over specific topics of relating to the budget. They're going to be topics that are separate from what you're going to be hearing at full council over the next 2 months. And we went over a review schedule, and we have added to that review schedule based on last week's meeting a few items. And I'm going to take this out. You all have it in your packet, I presume, but just so you can see this. So today we're going to be covering our non-departmental revenue assumptions in a little more detail than you've seen in the past. We're also going to be showing you a multi-year forecast that actually goes out to fiscal year 2017 that goes so 2 years beyond our 2-year plan to see how things are looking on a longer-term basis. And then next week we will be talking about the fees and also another item that's not related to the budget, but it's the proposed sale of water refunding certificates of participation. We'll have consultants here to talk about that. And then after that, you can see the items we added per your request. You can see the enterprise fund, fees and charges, but then we start with the impacts of CalPERS, or include the impact of CalPERS planned rate increases. Those are no longer planned. Those have been approved. They will be a 5-year rate increase over starting in 16 through 2020. So we'll kind of give you a sense of what that looks like over that period of time. We'll also be discussing the human services funding decisions and the timing of that, and then included with that in the same meeting the third quarter review. So just wanted to show you that we have added items as you requested, and I think we also have one other item that you requested, or a couple. One is the unfunded liabilities, recap of that per Mr. White wanted to see, even though we've talked about that kind of in this context to see what they look like and what they total. And then lastly, understanding how unfunded infrastructure liabilities have changed over the last 10 to 20 years. That's going to be a challenging one to kind of quantify that, but we'll do what we can on that.
Okay.
So today, again, 2 topics. The revenue assumptions, and we're going to go into some detail with that. And then we're going to go over the multi-year forecast. With respect to the revenue assumptions, it's important to note that we built our 2-year estimates on information we had at approximately January, February. So what you're going to see is what we based our projections for the current year, the next 2 years. Then you'll see how that information, new information that's come in, how that affects our projections now. And for the most part, I don't think we're going to need to adjust our projections, but there have been some variations since in the last few months in what's come in relative to what we were projecting earlier on. So you have a handout on all of this, but I just have it on the screen for the benefit of the public, assuming they can read this. So the way this is organized is it has 2 years of historical data by quarter, and then it gives you real information for the current fiscal year. And so when we are making our projections for the current year, of course, which is what we build upon for the next 2 years, we only had 1 quarter of information. We had at the far right, 5,045,000 is the only information we had for at least for this current fiscal year. Everything else related to the prior year. And in that quarter, we realized a 5.2% growth in relation to the prior quarter. And what we assume for the remainder of the year is that we would grow at about 4.5% for the remaining 3 quarters. And so that we would end the year at 4.7% with 20,019,000. You can see that the next quarter we got in, which was in March 15th or thereabouts, was at 4%. So we hope to or projected to get 4.5% for the remaining 3 quarters. The next quarter that comes in is only at 4%. Still a good quarter, but not quite where we thought. So we're probably going to need somewhere around 4.8% growth for the remaining 2 quarters in order to achieve our estimate of $20,019,000. And if you look at historically, obviously we were pretty bullish on sales taxes because in the previous quarters in 2012 we were at 8.8% on average, so we were well above the 4.5%. So we felt pretty good that achieving a 4.5% growth for the remaining 3 quarters was was going to happen, particularly based on a 5.2% growth rate for the first quarter. So we have a little bit of pressure on us to get to the 4.7, but I still think it's possible.
Sure. Mr. White.
What portion of this of sales tax does the city get? I mean, when there's
Sure.
what's the rate, and how much of that comes to the city?
The rate currently is 8.25% or 8.25%, and we get 1% of that. That's the
One of the 8.2.
one of the 8.25. And then that's the general fund. We also get the Measure A half-cent sales tax that goes into our special revenue fund,
Half cent.
half cents. And then we actually get a small little sliver under Prop 172 for public safety. And it's a total of about $350,000 to us. And that does go into the general fund, but it's in the police department's budget.
Thank you.
So at the bottom here, all this really indicates is that when we were looking, making decisions about what we would be projecting for 14 and 15, we put together some scenarios about, okay, what if revenues grew by 2.5%, 3%, and so on. And we we ended up where it's shaded at 3.5% for the next 2 years. So you could see that we were somewhat conservative in what we were thinking next year's growth would be. We were projecting a 4.5 or 4.6% growth this year. In the next 2 years, we projected 3.5%, primarily because we've had such great quarters in the last 2 years. Hard to continue that kind of growth, on a sustained basis. And we just don't know what's going to be out there. The economy is still fairly uncertain. We think it's kind of made the turn, but we thought it'd be better at this point to be a little more conservative than more aggressive. With property taxes, I'm sure you know this, but the way this works is in January of each year, the county establishes the assessed value. They put the lien on the properties based on the values that were of the prior year, and they would add to that number either 2% or a CPI, whichever is less. So they take prior year's assessed value, add a CPI factor for a maximum of 2%, and that becomes the assessed value. And that is the basis upon which they tell us, because they notify us in September, this is what you're going to get. It's based on an assessed value. So we know what the secured and unsecured portions are going to be early in the year, September 15th, thereabouts. So we have no question about what we're going to get for those two components. What we don't know are what are we going to get for the for the supplemental portion. That's when properties change hands or there are improvements that are made after January, the lien date. Those supplemental assessments come in throughout the year, and we can't predict those. We also get what's called an airplane tax, and I'm not sure you're aware of this, but airplanes are subject to a 1% tax. It's sort of like a registration fee, but it's 1%, and it's based on the depreciating value of that asset. So it doesn't go up every year by CPI. It's sort of like your registration, your vehicle, in this case, the aircraft depreciates every year. So it's based on 1% of the depreciating value. The monies are allocated between the city, where that airplane is located, and the county and the school district. It's different than the way normal taxes are allocated. It's 1/3, 1/3, 1/3. So for the assessed value of airplanes, we get 1/3 of that, and we get about $400,000 a year on that. We don't know what that's going to be ahead of time, so we have to kind of project that. So what we're looking to do throughout the year is to determine. We know what the secured and unsecured portions are going to be, what's going to be supplemental, what's going to be the airplane, and that's really our analysis about projecting for the year. And those are the only two variables. So you could see in 2012 on the top left what the property taxes were, both secured and unsecured. They only came in at 0.2% ahead of the prior year. Our airplane tax was actually down at 2.8%. We also get some interest on monies that the counties hold. And supplemental was down by 28.5% to $230,000. We've seen supplemental taxes in the sort of the good old days prior to 2007 being close to $1 million. That's been, I think, our max, but we've always been higher than $500,000, so it's a pretty low number these days. And then you see the county admin fees of $431,000 last year. If you look immediately to the right, where you see the year-end estimate, you see it's gone down by almost half in the green box. As you know, there was a court decision recently that determined that the county was overcharging us for property tax administration fees. So this, in 13, is the first year they've lowered that. We just got a check or a wire transfer from the county for about $1.1 million for the amounts they've overcharged us and charges in the prior 5 years. So that'll be one-time money into the general fund. So for this current year, 13, our projection at this point, based on what we know from the county, is we're going to see a 2.2% growth in the secured portion and unsecured. Our airplane tax, we just got that, so it's $408,500. And the supplemental is now an estimate. We have received about $190,000 year to date. We're projecting $204,000, and you can see our county admin fee below, reducing that total. We are also going to be getting, on an ongoing basis, a share of the RDA's tax increment that they were formerly getting. We are going to be getting about $1.5 million per year. And then below that, you'll see the one-time payments from the built-up reserves that the RDA had that we had to remit to the county. That's our share, the 13%, almost $2.3 million. For the next 2 years, we are essentially saying that our secured and unsecured taxes are going to go up by 2%. Relative to what they were last year and what we know this year, we think it's a pretty good number. There's potential that it could be higher than that, higher than 2%. As you probably know, the real estate market is starting to heat up. It's also a slow process before that converts into higher assessed values and therefore higher property taxes. But we think 2% for now is a good number. We'll obviously reevaluate 15 during the mid-cycle review, but that's what we're going with right now. We're not assuming any growth in the other areas. In terms of airplane or supplemental, we're assuming it's going to be relatively flat.
Mr. White.
Do you keep track of the number of property transactions that have occurred recently? Do you have a sense of that?
We don't, but we'll talk about that in the context of real property transfer tax because that gives us a sense of that sort of the volume of transactions or sales that have occurred. So any questions on the property tax component? I think the only thing I wanted to, I'm sorry.
No, it's fine.
I just wanted to point out that the updated estimates here, we now are, and I misspoke because in the yellow you'll see the supplemental, we are now estimating $250,000 based on a payment we just got. So we were originally estimating $204,000, we are now estimating $250,000. And then below that, you can see that instead of the $1.5 million that would be the general fund share of the tax increment that the RDA used to get, we have now got a final number, and that's $1,680,000 is what we gain. So slightly higher than we had anticipated. So with the bed tax, goes back 2 years as well. It shows every single month. And if you look at 11 and 12, the growth rates we've seen in the last 2 years, they've been pretty staggering. And if you think historically, we would typically get between 5 and 6% per year. Even during the good years, maybe 7%. We're seeing a lot of months with double digits. We are at 8.7% in 11, 9.7 in 2012. When we made our projections for the year, for this current year, which is down at the bottom in green, the $14,000,007, we had essentially 6 months of information at the time. And at that point, we were right around 7% growth. We have since received 3 payments in January, February, and March. You can see that 3.4. We're down actually 1 month. That's the first time I think we've had a negative number. For January, February, 1.8, and then it rebounded again in March to 12.4. So far, year to date, we're at 6.6%. Our projection for the year is, again, 14.7 is about a 7% growth. So we're just a little bit behind, but I think we have a pretty good chance of achieving that number. Question?
Yeah.
Yes, Mr. White.
Thank you, Mr. Chair. Is that March number, is that a first month of Orient Express revenue, or is that still not?
Orient Express, you mean?
A couple of weeks.
Yeah.
Okay.
There were 5 weekends. There were 5 weekends in March. Right.
Okay.
And at the bottom, you can see what we projected for the next 2 years. So we've assumed a 5% growth next year, and then a 5% growth on top of that for the following year. The one thing I will say is that we have added to this year's projection an additional $100,000 in revenues because of the opening of the El Encanto Hotel. So they opened in March. We made some real, conservative estimates about that for the next 3 months. And then on top of that, for next year, since next year will be the first full year of that hotel being open, we made an estimate of what that would add. And I don't want to disclose the dollar amounts, but essentially our growth rate will go from 5% next year to an expected 10.2%. So it more than doubles our growth rate that we're projecting. And then for the following year, then we're just assuming a 5% on top of the higher base. So obviously the opening of the El Encanto is a big boon for us. So this is a real property transfer tax, and kind of to your question, Mr. White, this is based or assessed whenever any property changes hands. So typically a sale of property, it's assessed at $1.10 per $1,000 in assessed value. We get half of that. The county gets the other half. So we essentially get 55 cents for $8,000 of value. And to put it into perspective, for every $1 million of a home sale, we would get, or the city and the county would split $1,100. We would get $550 of that. So it's not a lot of money in terms of for the magnitude. So when you look at how much we're getting per year, you can see that there's a lot of dollars involved here. What you'll notice throughout the last couple of years that the number is volatile. There's really no way for us to predict what that's going to be. Every month is unique. This year has been pretty strong, particularly because in the month of December we got a payment of $121,000. So you can imagine the amount of sales that must have occurred during that month or the prior month in order for us to generate $121,000. But obviously that's bumped up our number for the year. We, at this point, so far, are $480,000 in the year. We're projecting $600,000. That's a lot higher than we've seen in the past. You can see last year we were at $372,000. The year before that, $388,000. So a $600,000 projection is pretty good. We're hoping we achieve that, but based on that one payment in December, we think we'll get there. And as you can see below there, the projections for the next 2 years, they're actually below what we think they are this year. We're not expecting that one-time, bump in December again. We think it's going to normalize more into the 500,050 range. That may be a little aggressive based on what we've seen in the last couple of years, but it could also be indicative of the fact that the real estate market is getting better. Lower end properties are really starting to sell, so we're starting to see a lot of that. And we typically see this as a kind of a leading indicator for us as to what property taxes will eventually do. Because the more volume, obviously, if the assessed value is below what the sales prices are, then we're going to likely see, following these transactions, some increases to our property taxes.
Mr. White?
Thank you, Mr. Chair. Do you keep track, or I expect the county does, track of the disparity between true assessed value and the Prop 13 assessed value? Do they share that information with you?
That's a good question. We have not been able to get good information from the county. I presume they have that, but we've not been able to get that. But that's really what drives, whether or not we're going to see any increases to our property taxes. Because if a sale occurs that's actually below their assessed value or at it, we're not going to see any benefit from that. It's only when the sales prices, exceeds the assessed value. And so, no, we don't have any information to be able to tell us exactly how that's shaping up right now or what it looks like. But that would be good information to have for sure. Okay, the last one, and I'm not going to go into this in detail, but this is mostly to kind of show you that our utility users tax is one of the most complicated items or revenues for us to estimate or project, because it's made up of so many sectors that behave pretty uniquely or differently. The way this is organized is we have historical information, but on the left you can see the categories of utilities that are subject to our tax. The tax is 6%, except for anything related to telecommunications, which are cellular, VoIP, or which is voice over internet protocol, and telephone. Those are 5.75%. When we modernized our ordinance, our TOT ordinance a few years ago, and got approval from our voters, one of the things we did was to lower it from 6% to 5.75%. But the categories are, again, the telephone, which includes those three components I mentioned, cable TV, electric, gas, natural gas, and refuse and water. And if you look to the left, you can see that the growth rates in 11 are all over the place. Cellular, in particular, is down. VoIP is up, but it's a small dollar amount. Others are sort of slightly up or down. In 2012, a little more volatility. Cellular continues to go down, but not as much. The VoIP went down by 12%, telephone down. So the point is that it's really hard for us to kind of project where we're going to be. We've done quite a bit of an analysis to say where do we think we're going to be at the end of this year, and really to cut to the chase, the bottom line in the orange colored boxes, we're projecting $6.8 million this year. And that's against the budget of about $7,015,000. So we expect that we're going to be under budget this year. For the next 2 years, in spite of the fact that we've only seen very moderate growth, if any, we're projecting a 2% growth rate in our revenues for the next 2 years. But it could be anywhere. You know, it doesn't go beyond. You know, it's usually in a 2% growth or decline band, but we just don't know which direction it's going to go.
Okay.
Mr. Chair, how does cell revenue go down? I mean, isn't that still a growth?
You would think, yeah.
Data and all that stuff.
Yeah, I don't know why it's down. I would have expected it to be up. I would expect to see landline or normal telephone to go down and then be replaced with cellular. It could be, and I know that just nationwide and in California as well, that there has been an increased usage of what are called prepaid phone cards and prepaid telephones, so that you go to Walmart and you basically buy time. You don't have a contract with any kind of a carrier like Verizon. You just get yourself a device and you get some prepaid minutes, and that's how you go about it. And there's been an increased movement toward that, which means that we're losing tax on that. And there is a movement right now for us to see if we can start capturing that. We're working with the telecommunication companies like Verizon and trying to see if we can get people who buy these things, these prepaid cards, to pay their tax at the point of sale, just like with sales taxes, and the State Board of Equalization would collect those taxes on our behalf. But that's kind of a ways down the road. But we are losing some revenue, so that could explain some of that, but I'm not sure.
And then secondly, there has been some change in the sales tax enforcement on internet sales. Can you talk? Does that affect the city at all?
Oh, sure. There is some legislation at the national level to try to eliminate what's been, I think, about a 20-year moratorium on internet taxes. So people who have had no presence here in California but have been transacting sales here have been able to escape our sales taxes. So there is some movement now to try to establish and require that even internet-based companies have to collect sales taxes that are remitted to the state and local agencies. So that is something that's in the works. My guess is that this year something will happen, and we'll see that happen.
Okay.
Okay. So the next slide, and I'm not sure I can put this on the chart, but this is the longer sheet. I'll try to put it up here. This is I guess a more condensed version of the multi-year forecast you've seen in the past. And I'll start with what you probably have seen before. And just it's important to note that in the revenue category, all those growth assumptions are based on what we just talked about. So going out to 15, it's all based on what we're projected this year and what we're then assuming for the next couple of years. And at the very bottom, this is consistent within the recommended budget on the two columns on the right, a surplus of $429,000. And then a surplus in year two of $650,000. So that's nothing new here. This is exactly what we've seen before.
Sorry, I'm looking for the 429.
Yeah, so if you look at the fiscal year 2014 recommended, and at the very bottom, and then 15, the same thing as 650. So what this tries to do is to give you a sense of what we think is going to happen in the next 2 years beyond that, so 16 and 17. And really, the thing that's particularly going to be unique or different in 16 versus the 2 years prior to that is that that's going to be the first year that the PERS rate increases will begin. PERS board has adopted a plan that says we're going to implement rate increases starting in fiscal year 15 for a 5-year period that in total will reach approximately 50% of an increase. So, for example, if we are today, in terms of dollars, if we're paying $50 million to PERS in the general fund, then our expectation is that by the time we hit fiscal year 2020, that we would see that go up to $22.5 million. So a 7.5%, $7.5 million increase, 50% increase. But it'll really be in terms of the rates. So on the revenue side, what I've done is you can see I've made some assumptions about what revenues would grow. The first row is the property taxes. I'm assuming actually that things are going to get a little better, that instead of a 1.9 or 2% growth, that we're going to see more like a 2.5% growth in property taxes. Again, based on the fact that we see real property transfer taxes increasing and that just the market in general is heating up. So a little more aggressive there. Sales taxes is the second row. Still assuming 3.5% in this, at least in this forecast. And this is a very rough forecast, but 3.5% in the 2 years beyond. For our bed taxes, assuming 4.5% growth, it's based on the idea that if we're having really very strong growth, very hard to sustain a 6% growth rate or 5% growth rate, on a long-term basis. So conservatively, it's assuming 4.5% growth. And then for UUT, 2% in each of the 2 years, and so forth. But what I factored into the expenditure side, and that's the second sheet that you have in front of you, if you look at the detail behind this, it focuses on just the salary and benefit category or row. And so this is all the detail that goes into that one number, the $91,358,000 in 16 and then the $94,900,000 in 17, all the components that go into salaries and benefits. And I provided you this because I wanted you to see what assumptions I made for this. So the very first row is just the salaries, straight salaries. And I made an assumption in 16 and 17 to the right that we have a 2% increase to salaries. That's what we have in the 2-year plan, and I just carried that out to the next 2 years. And everything related to those salaries, like hourly salaries and overtime, and as well as what's called FLSA overtime, I've just added 2% to those costs. Toward the middle, you'll see benefits, group insurance. I've assumed 2.5% increases to those costs. Now, our rates or the insurance premiums will actually go up higher than that. They've been averaging 5 to 10%, but the city doesn't always pick up all those costs because the employee sometimes picks up a portion of that. And then, but the big change, of course, is the retirement benefits. I mentioned that they're going to go up 50% over a 5-year period, which means 10% per year, right? So 10% in year one, and every year 10%. But we also have to factor in the salary increases because salaries that go up 2% means our retirement costs will go up 2% regardless of what the rates do, if rates stay the same, right? So effectively, a 10% increase to the rates, it translates into a 12% increase if you add a salary increase of 2%. Does that make sense? So it's really the 2% up above that we're assuming for salary growth on top of the 10% that PERS is going to be implementing, which is therefore a 12% increase.
So was their estimate 10% each year?
It's, I haven't gotten to the details, but they effectively said it's going to be rolled in over 5 years. I'm assuming it's going to be evenly, spread out over that year, that 5-year period. Okay. So I just took, basically I took 50% of our total cost and I just divided it over the next 5 years. And then everything else is, kind of inconsequential, but that's how I arrived at those two numbers, the $91,358,000 at the bottom for total salaries and benefits, and $94,900,000 in 17. So going back to the schedule up here, I've just factored that in, and everything else I've assumed that everything is going to be fairly flat in terms of supplies and services. The only thing I did increase for allocated costs, since those are tied to internal service funds and they're also based on salary costs, so I bumped those up by 3%. So really, the bottom line is for 16 and 17 is that we are going to still have a slight surplus based on this projection in 16, but then in 17, as these rates start to compound, for PERS rates, we're going to be expecting a $200,000 deficit. Again, very, very rough estimate, but just to kind of show you how this looks long term. We're going to obviously get into this in a lot more detail. This is one of the items in a couple of weeks we'll be covering. We'll be taking this out with more precision, I think, all the way out to 2020. I've got a lot of information from PERS on how they actually are going to implement these rate increases and how that's going to be spread. Is it going to be even or not? So we'll have a better idea of what to expect starting in 16 with these rate increases. And I will tell you that the increases that they're implementing starting in 16 are not the entire. They're going to be proposing other changes even beyond that. This is just to adjust for a change in what they call the smoothing period. You know, they've had a 15-year smoothing period for gains and losses. That's narrowing the smoothing period to 5 years, and other changes to their smoothing techniques. That's what's going to cause this 50% rate increase. Next year, they're going to be completing a study that would theoretically be coming in effect in our rates in 17, and that has to do with mortality rates and the discount rate. So every 10 years or so, they evaluate how long are people living. Is it consistent with what our assumptions are? Back in 2002 or 1, when they did this, they found that people were living longer, particularly public safety personnel were living longer than they originally projected. So they do that every 10 years, so they're doing that again. And they expect that that's going to cause some increases to the rates in addition to what we're talking about. And then this doesn't reflect the discount rate. They're still evaluating whether or not 7.5% is a realistic number to assume in terms of investment returns. So as part of that study, they're going to evaluate whether they should lower that. And I think there is pressure on them to lower that to I think down to 7, but my guess is going to probably be 7.25%. So that'll roll in theoretically in 17, but my guess is that they're going to evaluate, you know, what's the time period and when do they start making those impacts, because the changes alone are going to be significant to a lot of cities, including us. So anyway, there's just more bad news on the PERS side beyond what we're going to be presenting to you in a couple of weeks.
Mr. White?
Thank you, Mr. Chair. I'd appreciate, as I recall, there was quite a bump this year as well. Was there not a significant increase from or anyway, recently, wasn't there a significant increase in PERS costs? So I just, as we have the discussion later, don't need to go into that now, but just that let's have that look at the full lift that went on that's going forward.
Sure.
Thank you.
Any other questions? Okay. So that concludes my presentation. And then next week, as I said, we'll continue with general fund proposed fees, and then we'll also have the non-budgeted item, the water funds, proposed refunding the certificates of participation. So unless there are any questions, that completes my report.
Thank you.
You're welcome.
Meeting adjourned.